week. This time, we're looking at an investment thesis on NBIS Group, ticker NBIS. The piece frames it as an emerging AI infrastructure player, the neo-cloud, and maybe the next big growth story, backed by some multi-billion-dollar contracts.
Right. I've got the material. It's a very powerful read. It jumps right in, arguing the whole AI bottleneck has moved, It's not about owning the GPUs anymore, but about owning the specialized compute capacity to actually run them. So let's dive right into that central analogy.
Okay, so a key theme here seems to be positioning NBIS, not just as, a high-growth stock. It's about this pivot to them being the structural, specialized infrastructure play, moving past the chip bottleneck to the compute capacity bottleneck.
That structural point is exactly right, but I think the primary analogy needs a bit of sharpening. Right now, it leans a little too heavily on a simple revenue comparison. It needs to shift to a more defensible structural comparison, something about capital flow and strategic scarcity.
So the main idea is that the core analogy has to move from just comparing revenue growth to comparing the actual structure of the business, the capital, the scarcity.
Precisely. The weakness right now is that while the, 355% year-over-year revenue growth is incredible, and yes, it's reminiscent of NVIDIA's early breakouts, as the piece says, just relying on that number makes NBIS look like any other high-flying, volatile growth stock.
And if that growth slows down, the thesis just crumbles.
It crumbles. And that next NVIDIA framing is, technically a misnomer. Their business models are almost inverted. The thesis needs to defend the strategic similarity, the scarcity premium, much more rigorously.
I see what you're getting at. If the whole point is scarcity, it has to be a type of scarcity that only NBIS can really provide, and more importantly, maintain.
Exactly. So the suggestion is to reframe the core analogy. Position NBIS as let's call it a utility-scale captive infrastructure partner. The thesis should link that big risk capital intensity not as a negative, but as the price of admission. It's what builds the long-term moat, just like in any other capital-intensive utility.
So you take the biggest perceived weakness, the insane CapEx, and you flip it. You make it the biggest strength, the utility moat. How could the author make that contrast really pop for the reader right away?
Well, for one, they could introduce that utility moat concept very early on. Contrast NVIDIA's model, high-margin, low-capex design work with what NBIS does, which is a high-capex, high-security execution business. That immediately sets up a very different and I think more defensive argument.
That makes a lot of sense. So we're not comparing apples to apples on revenue. We're comparing them on structural dominance.
You've got it. And that fixes the weakness because you start to emphasize that the huge amount of capital you need to build these specialized liquid-cooled data centers for, 10,000 plus GPU clusters, that cost is precisely what locks out smaller competitors.
And it forces the giants like Microsoft with that massive $19 billion deal.
Right, and Meta with their $3 billion deal. It forces them into these long-term, high-value, captive contracts. They have no other choice.
So the argument becomes, those huge contracts aren't just revenue, they are validation of the high cost of entry for this entire market.
Yes, that's the concrete takeaway. The author should discuss how those contracts basically turn NBIS's capital expenditure into a giant barrier to everyone else. And that elevates the whole thing from a simple growth trade to a defensible, long-term infrastructure investment. It answers that headline question, is NBIS the next NVIDIA? Structurally, no, but in terms of creating strategic scarcity, absolutely.
That framing is so much stronger. It answers the sustainability question before the reader even thinks to ask it. Okay, so let's shift to the capital structure. The piece correctly points out the net loss, about $120 million in Q3, and just the sheer amount of cash needed to fund these deals.
And with infrastructure projects this big, needing billions in CapEx, that capital risk is, it's paramount. It's the first question.
So the core of this next point has to be that the analysis of capital intensity and dilution shouldn't be an afterthought. It needs to be integrated right into the bull case, presented as a controlled, necessary part of the strategy.
Exactly. The weakness here is really structural. It's about the pacing of the document. All those critical risks, capital intensity, dilution, execution risk on that huge Microsoft deal, they're all kind of buried back in Section 5.
Way too far from the revenue upside in Section 4.
Right. And isolating it like that makes the whole capital question feel like something the author is avoiding, rather than a variable they're actively managing. And any sophisticated reader is going to zero in on that immediately.
I agree completely. If I'm reading about a high-growth infrastructure play right after I see the big revenue numbers, my first question is, okay, how are they going to pay for this without going bankrupt or just destroying shareholder value? Pushing it to the end feels defensive.
It does, so the suggestion is to be proactive. Address the financing mechanism right inside the bull case, show the reader how management can actually minimize dilution and deploy this capital effectively. The thesis has to give confidence that the company is managing this transition from a speculative startup to a mature capital-deploying factory.
Okay, but hang on. Isn't relying on future guaranteed revenue to justify current stock dilution still, it's a high-wire act, right? How does the author convince us this dilution is really controlled and not just a desperate necessity?
That is the critical distinction. That's the work the thesis has to do. And they can start by just quantifying the potential dilution up front. Do the math for the reader. Analyze what a, say, $1 to $2 billion stock sale would look like. What's the impact on the current market cap? And then argue why that level of dilution is acceptable, given the massive revenue floor these contracts provide. When you do the math, you demonstrate control.
That's a powerful shift. It changes the narrative from they're losing money to they are managing a calculated, controlled CapEx build-out. How else could they show that level of control?
Well, they should highlight the meta deal. That's $3 billion over 5 years. That's a guaranteed high-visibility cash flow buffer. You can frame that as providing non-dilutive support for the ongoing build-out. It's like an insurance policy against execution risk.
That definitely helps, but the scale of that Microsoft deal still feels like it demands a huge chunk of capital right now. Is there any alternative to just pure equity dilution the author could bring up?
Yes, absolutely. And they should. They need to discuss NBIS's access to debt markets, for sure. But, and this is crucial, they should explore whether these big contracts include structured prepayments. That's often standard practice in utility-scale deals. Microsoft or Meta paying up front to fund the build-out of their own capacity.
Wow, okay, that's a game changer.
It is, because it shows the customers essentially co-funding the project, absorbing some of that CapEx risk themselves because they need the scarcity so badly. That demonstrates a whole other level of financial management.
Yeah, it completely changes the risk profile. Okay, let's move on to the tech. The material makes a really strong case for their proprietary SilverReader technology, the whole Slurm on Kubernetes thing, as their key technical moat.
I agree, it's clearly the secret sauce, but I think that moat needs to be reinforced a bit. To really justify that scarcity premium, especially over private competitors like CoreWeave, who are already Kubernetes native. The piece needs to spell out the specific economic consequences and the engineering lock-in that SilverReader creates.
So the central point for this section is, to justify the premium, you have to connect the SilverReader software directly to hard dollar savings and real engineering lock-in.
Exactly. The weakness right now is that the benefit is described a little vaguely. It says it reduces idle time and saves customers millions, which is fine, but it doesn't explain why a customer couldn't just migrate away eventually or why it's a real barrier. Like, why doesn't Microsoft just build its own version of this?
Yeah, I came away from that section knowing Specs Operator was important, but I couldn't tell you the hard dollar value. It felt more like a cool technical feature, not a competitive weapon.
You nailed it. So the suggestion is to quantify the efficiency gain. Put a number on it and emphasize how this solution is specifically for the most sophisticated users, the ones who depend on those legacy high-performance computing or HPC workflows. You have to translate the tech into hard savings and real switching costs.
We need numbers, even if they're hypothetical, to just anchor the value proposition in the reader's mind.
Absolutely. Provide a hypothetical metric. Explain that if Slum Operator reduces expensive GPU idle time by, say, 10 to 15% compared to retrofitting standard cloud schedulers, which is a huge industry problem, by the way. That translates directly into massive cost savings for a customer running 10,000 GPUs. If it saves 10%, that's not just $10 million saved. That's 10 million Meta can pump back into R&D. That's faster time to market. That's the scarcity they're buying.
And we should probably flesh out the Slurm compatibility part more, since that's a huge differentiator from the standard hyperscalers.
Yes. Explain that this bridges the gap for all those AI researchers who grew up on old-school supercomputer schedulers like Slurm. This lets Meta or Microsoft accelerate development on things like Llama without forcing their existing teams through massive, costly engineering migrations. It boosts their velocity.
So it's not just about saving money on features, it's about reducing engineering migration risk.
Precisely. And then, and this is key,
the author needs to use the term engineering lock-in. Describe how integrating this proprietary orchestration layer creates friction and real cost if Meta or Microsoft ever tried to move that workload to another provider. It's what solidifies the value of that $19 billion contract. It makes leaving prohibitively expensive.
That's fantastic. It completely transforms Superoperator from just nice software into an explicit economic barrier to exit, a permanent advantage.
Okay, so to summarize, the key actionable steps here for the author. First, refine that structural argument. Shift away from the simple growth analogy to a more defensive utility mode story, where the high capex is the barrier. Second, control the capital narrative. Pull that capex and dilution discussion right into the bull case to show financial sophistication. And finally, monetize the technical moat. Translate what Superator does into hard percentage savings and concrete engineering lock-in.
So the overall assessment here is that the material is strong. It clearly identifies this core opportunity, this next phase of AI infrastructure. But strengthening the defense against those inherent execution and capital risks will really maximize its impact. It'll make it appeal to the serious institutional readers who are looking for a true infrastructure play, not just another growth stock. We would definitely encourage the listener